Hey traders, welcome to the Top Tier Outlook. We're kicking off a look at the week here on Sunday evening. Thanks as always for joining the show. And of course, as always, if you have any questions, feel free to type them in. We'll take a look at what we're dealing with as we're getting a very, very early look at the open as the Asian session is just, and I mean just getting underway. A couple things to note about Friday. Friday was a very interesting session as we dealt with the end of the month. Uh, April's end of month was pretty darn volatile. March, February, and January were pretty docile. So 5 months in, we've seen end of month shenanigans a little bit more so as, if there's anything that's corresponded with more volatility at the end of the month, is the fact that January, February, and March had far more a convincing and far more macroeconomically supported uptrend, which is to say, back then, we were pretty darn certain we were going to be getting somewhere between 3 to 4 rate cuts from the Federal Reserve starting as soon as May and June. That, of course, changed over the course of the first 90 days of the year. So April and May were subjected to a lot of, well, are they going to cut at all? And how few cuts could we get? So it's kind of interesting as the macroeconomic uncertainty has really started to set in. The end of the month in April and May were far more volatile. Nonetheless, though, and this is, if you've been watching this show for any period of time, you know this, that we are still in the midst of an overall uptrend. And I'm going to put the S&P up here. There we go. We are still in the midst of an overall uptrend, not the kind that we saw back in January, February, March, but it's hard to look at punching up to higher highs on, say, May 23 as something that's inherently bearish. Yes, we're seeing volatility. Yes, it's far more a wobbly trend than we've had before, but this is certainly not a downtrend. And that's something that we want to keep in mind as we go into June. Now, the whole notion of sell in May and go away. I hope that if you've been following Charts and Coffee or are in my Sector Secrets Mastery, or even following here along in the Top Tier Outlook, that you know that the data doesn't support this notion that sell in May and go away means anything more than less activity, less major decision making through the summer months. Just call it Memorial Day to Labor Day. It doesn't, even though sell in May and go away, sort of the general gist of it sounds like short through summer, or summer should be bearish. That's not the case at all when you look back over not just the past 10 years or 15 years, but decades back of typically what happens between May and September. That said, we know that we're coming into an election year, which is typically actually a bullish year. We know that we're looking at, and I shouldn't say we know. Let me show you, because data is everything. Let's jump on over to the data. And what we want to look at is what's happening with the Fed fund futures. What is the expectation of rate cuts by the time we get to the end of the year? So I'm going to fast forward out to December, and you'll see that there's at least one, if not two, rate cuts that are prominently featured on the expectations. Now, this is not just some metric. There's a lot of metrics about perceiving what could happen, extrapolating from what Powell might say, or looking at whatever. This is actually a look at something called the Fed fund futures. And the Fed fund futures are a futures contract, just like crude oil or gold or the S&P, where people can, with contracts that correspond with each FOMC meeting, we can look at the way in which Fed fund futures traders are speculating as to where rates will be when the meeting's results are announced. It's really no different than the way bond traders would be speculating on where yields will be in September or December. So this is actual data coming from actual trades. And that's why I like this the best, to understand what's factored in, what's discounted, what's baked into the cake. And you can see here that if the current rate is 525 to 550, that's this column over here, there's only a 15% chance that come December 18, that we're still trading at only with no cut expectation. Almost 40% expectation for at least one cut, either at that December meeting or before, and then expectations for a quarter point cut at that meeting and one that would have happened before it. So it could have been a cut in September or November and December. So this column here at almost 34% reflects two cuts, one at the December meeting and then one that would have happened anytime between now and that meeting. And then you can see here, we get down to a negligible 11%, 1% for anything more than two cuts. So two cuts are about as good as it's looking. And when you think about it in that way, it makes sense why the equity markets are very grudgingly punching up to higher highs. And it doesn't have to be the Federal Reserve cutting rates as the sole reason for the rally, but that's a lot like adding gasoline to the fire. As we go through earnings season, as we get splits like we're anticipating with Nvidia, as we see individual stocks continuing to hold their own. I mean, case in point, we have a long position in the sector secrets mastery in Apple, and we have for a handful of days now. When we see movement like this in a heavily weighted name, one of the magnificents, right? It's hard to be a bear, and that's where I'm going to continue to look at, even if the Fed doesn't cut rates. Right? We've easily dropped our expectation for that every month since, I'd say, mid-March this year. And it hasn't taken out support in a meaningful way. One of the things that I did in the Friday, checked out what we're doing in the Sector Secrets Mastery. If you haven't checked out the premium videos, we get into a lot of detail about this stuff, whether that be, the sanity check video that I did on Friday. That's at the Simpler Trading YouTube channel. You can check that out after the show. You'll see where the sanity check is, hey, let's put a measuring stick to what we saw in the NASDAQ or the S&P or the Dow or the Russell on Friday. And really, how much have we pulled back from those highs? And I think the most important thing that stands out with the NASDAQ is we did pull back. And you can see even a 3% pullback would bring us to 18,452. And we're above that right now, right? And we have an uptrend on the NASDAQ. On the S&P, you'll see even a 3% pullback from the highs of 53.68 and a quarter would have us down at 52.07. You'll see we're at 52.92 right now. We're somewhere between a 1% and 2% pullback. So these are not dramatic pullbacks in terms of the movement. In fact, you can say this is kind of the normal ebb and flow. Once we start exceeding 5%, that gets a lot of attention. Once we start somewhere between 5 and 10%, there's probably going to be some more emphasis on individual sectors that might be dragging that particular index down. So case in point, we know that energy hasn't necessarily been doing the Dow any favors. Take a look at what's going on with XLE. Financials have been a little bit rocky. You can see here. So if I'm looking at these highs from 42.49, a pullback to 40, right, is just about a 5% pullback. Compare that to the S&P at between 1% and 2%. You can see the 5% pullback on the XLF. That's going to drag the Dow down in a more specific way because the XLF is the number one weighted sector in the Dow. It's the number 2, by the way, in the S&P. So if you're concerned with energy, if you're concerned with what's happening in crude and crude oil stocks, and you're concerned with, financials have been kind of volatile, one of the easiest ways is to simply trade around it. And trading around it means you understand these weightings, which, kind of at a nice surface level here, you now do. And so the NAS should be best poised for continuing upside. 2 out of the top, those magnificent 7 stocks have a big event early in June. Apple has the WWDC, and Nvidia, of course, has that stock split. And I would absolutely anticipate that Nvidia would continue to move higher as we approach that stock split. That is very typical retail trading behavior in front of a split. And then after the split, don't be surprised to see Nvidia pull back about 10% post-split. That's a buy the rumor, sell the news. A lot of the long positions will be positioned not in a way to necessarily want to own Nvidia in these north of $1,000 share prices, even with the split that's coming up. A lot of that is just the speculation and the trade happening going into the split. The split will create some sell the news, and at that point, we'll likely see a little bit more of a pullback. So when traders ask me, Rog, but I'd like to put Nvidia in my portfolio, wait till after the split. Or Rog, I'd like to see what price would make sense to buy Nvidia. I wait till that thing closes in at about 950 to 900 before I even think about doing anything like that. But another way to do this, whether as a trader or as someone who wants to put shares of semiconductors in their portfolio. And by the way, we have our portfolio session in the Sector Secrets Mastery happening on Tuesday. So if you're not a member of the Mastery and thinking, Rog, yeah, I kind of would like to understand a little bit more of what you're doing, there. Check out while it's on sale until June 7. If you go to the Simpler Trading, here we go, the Simpler Trading website, and I haven't signed in yet, but if you go to simplertrading.com and you check out what's going on with the mastery, for example, our Sector Secrets Mastery here, you can check out and use the code MEMO 30, and it will knock 30% off whatever subscription you want to take a look at. By the way, this extends to hourly price movement ranges and daily price movement ranges as well. All right, so if you have shares, the question here is, would you sell if you have shares in SMH? Well, Leo, not knowing what your cost basis is, not knowing what your time horizon is, not knowing if this is something in your longer term portfolio or just a trade, let me just generally say, if it's a trade and you don't want to sit through the pullback, then yes, I would take advantage of whatever your trading plan was for your target. But all I'm saying is that as we approach that split, we're likely going to see that retail participation long. But once the split occurs, there'll likely be some profit taking on the rally that came into the split. All right, next up is, actually, let's go ahead and take a look at one of my favorite names in semiconductors. The SMH is one of them. The other one would be Qualcomm. Qualcomm was a bumpy ride. And let me tell you something about the way we manage the risk in Qualcomm on Friday. And many of you who are in the Sector Secrets of Mastery as well know that we have a little saying. I think it's the title of a book too. I wish I wrote the book, but it's called Best Loser Wins. That's the title of the book, but that's a really powerful way to think about risk management. The best loser wins, not the home run hitter wins, or not, fill in the blank wins. The person, the trader who can look at the risk and the validity of a trade. When is a trade idea no longer valid? When the option premium is zero? When the option expires? Those aren't really plans as much as they are forced exits. What we want to think about is, how do we put ourselves in a trade while understanding the risk to the account, putting a cap by way of percentage risk to the account, and then managing something as volatile as Qualcomm was on Friday. So we have typically 2 to 3 entries that we look at. We scale in. Now, scaling in is very different than adding. Adding we do not do. Adding, and I've never seen an exception to this, is a style in which you get in, doesn't go in your favor, and you dollar cost average. Now, dollar cost average doesn't sound that sexy. Neither does adding to a loser. But believe me, every time you see adding, it is indeed adding to a loser. Now, you might say, well, Ron, what's the difference between adding and scaling in? Great question. Scaling in is when we send out the alert on the trade, when I'm doing my homework and my analysis on a potential trade like Qualcomm, all 3 triggers, all 3 levels that I will be willing to buy a call in Qualcomm at will be presented all at the same time. Just like if you were building a building, you're not going to be given the blueprint one floor at a time, right? You're not going to be given it haphazardly. Someone's not going to say, well, here's floor number 1, and I'll give you floor number 2 when I feel like it, right? So remember, don't do that to yourself. Have the entire blueprint, the entire building, the basement, the roof, all of it. Have it out there at the same time. And then you can decide, well, maybe I don't want to be an aggressive buyer of Qualcomm on the end of the month. Maybe I would rather focus on the moderate or the conservative levels, knowing that we may not get there, but knowing that the risk can be managed from that level in a better way. The option will cost less, and cost is a function of risk. Everything has to be geared towards assuming you're going to be stopped out, because I can't control where the market's going to go. None of us can, right? Until we're writing checks and the bank bounces, none of us are controlling where a market goes. Even central banks can't. So what we can do, well, I guess if they cut rates, they kind of can, but that's a whole other conversation. None of us individually can predict where something's going to go, but we can control where we get off the ride if it's not heading in the direction towards where we want to be. So when I take a look at something like Qualcomm, I got stopped out of my agro shares by design. Got the level, got in, it lost a certain percentage, had to get out. But my conservative level was able to manage. And whether that's something like Qualcomm or SMH, I know that these should have a little bit of help going into that Nvidia split, because Nvidia is about 20% of the weighting of SMH. It's a very important stock that will determine in a lot of ways where the SMH goes, of course, where Nvidia goes, but where a lot of the stocks weighted within semiconductors will go as well. And this is the influence of high concentration weighting. This is the way we've got to think about getting in and getting out of our trades and what the catalyst for those decisions could ultimately be. All right, let's also take a look at copper and gold, because these two commodity futures contracts have been very much the reason that two sectors have been outperforming. Miners and metals, XME, and gold miners, GDX. Take a look at copper here. Yeah, it's had a pretty decent little pullback. You might say, Rog, how big a pullback is this? It's actually a pretty decent pullback, as you can see here. And really what I want to remember is that copper has lost its uptrend, but it's still holding. And remember, a pullback in an uptrend and arguably a broken uptrend is not a downtrend. A lot of traders look in a very binary way. Either the market's moving in an uptrend or it's moving in a downtrend. But actually, there's two other kind of connective threads, if you will. When an uptrend is broken, it's typically going to be in chop. A freshly broken uptrend does tend to be volatile and choppy. And so there is a behavior that is bullish chop. Same thing would be the same way if we had a downtrend and it was broken, we'd have a bearish chop. Well, it is bullish chop for a reason, because the trend that was, the sentiment that was, the opinion, the action that preceded this chop was bullish. And believe it or not, if you look back and, I look back on 30 years of what's more likely, V tops and W tops and V bottoms and W bottoms and reversals or continuations. And actually continuations are more probable than reversals. And this is not a reversal as much as it is an uptrend that has pulled back and simply gone into chop. And while it could eventually become a downtrend, the transition takes a lot more time than, oh my gosh, one big down candle or a couple down days. We can see something that's been very strong pull back and resume. And that's usually going to be the tendency for behavior. So keep that in mind as we're leaving May, where things got pretty volatile at the latter half of the month. But then the end of month had a lot of volatility, but you saw that surge in the indices at the end of the day. It tells us a lot. The last 3 days of every month tend to be a little bearish, redemptions, and the first 3 days of the new month tend to be a little bullish, but it's tendencies, right? Okay, here's gold. I definitely want to continue to focus on the long side of gold, and that's going to then feed the long side of GDX and things like NEM. And again, even though they're a little choppy, they're bullish chops. So keep that in mind as we're leaving May going into June. We're not seeing a lot of weakness in the broader averages. The NASDAQ is definitely the strongest, followed by the S&P. And then we have individual sectors like XLU, GDX, XME, SMH that are all outperformers. We'll talk about this more throughout the week. Remember, we've got non-farm payroll coming up this Friday. In the meanwhile, gang, enjoy the rest of your weekend. Thanks as always for being here for the top tier outlook. And remember, if you want to check out what we're doing here for our Sector Secrets Mastery, the trades that we've taken, we've had a good May. It's an account growth kind of month. Day trades have been pretty darn good as well. bot scalping, which is the Lorna bot scalping in the room, has been pretty productive. So come check out what we're doing, sectorsecrets.com. And please do use that code MEMO30 to get 30% off. All right, gang, that's a wrap. I'll see you tomorrow for Charts and Coffee.